Morning, welcome to ANZ News. It's Tuesday, 14th of September, Crypto Tuesday. As per normal, today we're talking BTC's overdue pullback and what does the future hold. The Bitcoin market experienced a high volatility sell-off early last week, with prices initially breaking up to a new local high of 52,849 US before selling down to a low of 44,196. What appeared to be the main driver on the sell side was a flush out of excessive leverage in futures markets. Meanwhile, in spot and on-chain markets, the historically significant trend of investor accumulation and long-term holding remains well and truly intact. Despite a 50% plus sell-off experienced in May, a strong rally from 29,000 US lows and another sharp sell-off this week, hodlers appear unfazed. After a very brief period of negative funding rates during the sell-off, perpetual markets have returned to a slightly positive funding rate, suggesting that traders are still expecting upside price momentum. However, the magnitude of funding is much lower than it was before the crash, suggesting that at least a partial deleveraging has occurred. The crypto market showed signs of stability entering the new week. Most crypto traders and investors would be looking forward to putting the volatility of the previous week behind them. The largest cryptocurrency by market capitalization, Bitcoin, found support near the $45,000 mark. The largest altcoin, Ether, showed strong character above 3,400 US. This new week would be crucial for the two heavyweights in crypto. The global crypto market cap stood at 2.12 trillion, marginal increase of 0.94% over the past 24 hours. The trading volumes dropped massively as traders remained watchful over the weekend. Bitcoin dominance also took a marginal dip, although the overall market capitalization increased riding on the back of an altcoin rally. That from Idil Patel, the CEO and co-founder of Mudrex, a global crypto trading platform. The overall crypto market recently touched 2.4 trillion since its upward trend from the third week of July in a likely rising channel pattern. We also saw a trend reversal in the last few days, which could be attributed to the recent market volatility due to Bitcoin adoption in El Salvador, coupled with a 2% dip in the US markets. The recent corrections saw some selling in high volumes. Bitcoin is also trading below its 200-day moving average. Other on-chain indicators are telling much of the same story. The Bitcoin mining market continues to recover after half of the hash power came offline during the Great Migration out of China. The 14-day median hash rate has recovered to 128 EH per second, which is approximately 29% below the all-time highs and reflects a 42% recovery from the July lows. The increase in hash rate is likely a combination of previously obsolete hardware finding a second lease on life, and miners in China successfully relocating or re-establishing or rehoming their hardware and operations. Competition in the mining market has continuously increased over time, leading the protocol difficulty to consistently rise. This growth has occurred despite the programmatic decline in new BTC issuance with each halving event. As a result, macro BTC rewards per hash have been in a long-term decline. Whilst miner incomes are denominated in BTC, their CAPEX and OPEX costs are largely denominated in fiat currencies. This makes miner effective revenues subject to price volatility. With such a large portion of the mining hardware offline and global production constraints on ASIC chip manufacture, the current mining market is finding itself slow to respond to elevated coin prices since 2020. There are simply fewer machines fighting over the same number of coins, trading at higher coin prices. As a result, miner USD revenue per hash has now risen back to July 2019 levels of $380,000 per hash, making operational miners exceptionally profitable on a historical basis. Despite being a large sell-off or capitulation event last week, long-term hodlers and institutions haven't budged an inch. Large entities holding over $500 million in value have added to their balances. It appears that the only profit taking occurring in the data is from A, miners, and B, short-term hodlers, or holders in this case. Coin dormancy has increased marginally. The variance is not at the levels seen during market tops historically. Liveliness is a metric that measures or provides insight into shifts in macro hodling behavior, helping to identify trends in long-term hodler accumulation or spending. Liveliness has been trending downwards for the last month and has continued that trend today. Also, for the last 3 months, the percentage of BTC held on exchanges has been sitting near 2-year lows, and it's continued that trend in the last week. A lot of the data points to a potential supply squeeze eventually occurring in BTC, especially if nothing else changes. We may still potentially see some panic selling in the short term. However, keeping an eye on the future long-term potential of the crypto markets, and an astute investor would want to hodl or see this as an opportunity to buy. While we may not be at the absolute bottom of this latest pullback, we're certainly near the bottom range. And that's our insight into BTC and crypto today. Thanks for joining us. Jump over to ainsleywealth.com.au for all things crypto. You can purchase, swap and sell through our website. Go and check that out. ainsleyBullion.com.au for all things physical. And of course, goldsilverstandard.com for our own cryptocurrency built and backed by real gold and silver. Enjoy your Tuesday, everyone. We'll catch you tomorrow for more news.